Triangle patterns, right triangle patterns, can be ascending or descending, and as the name suggests, ascending tend to be bullish continuation patterns and descending are bearish. Let's start off with some ascending examples. These triangles are typically defined by a roughly horizontal line and a sharper angled line, either ascending or descending depending on the direction of the stock in general. And once a breakout occurs above the horizontal line, or below in the case of the bearish, that is when the energy from that pattern formation is released and the move can continue. Just going to thumb through a number of examples here. Here's another one. We have our horizontal line at the top, the ascending trend line beneath, and we get a nice gap up and the continuation. Here's a closer view. And here's another. These don't always shoot straight up, of course. There can be some backing and filling in the process. And most normally you'd want to be updating your stop loss levels as the price moves higher. In this particular instance, a person along this position would probably have set their stop at this low, because as you can see, we get these intermediate term lows happening, and they probably would have been stopped out of the position in this instance, only to see it go a little bit higher. But that's really okay, because as you'll see later, when things start to go against the trade, it's usually prudent to tighten stops up just to try to preserve those profits. In this instance, we've got a fairly slanted line, but this would still be considered, I believe, a ascending right triangle. And there's another very fine example, moving from a breakout of 35 up to almost twice that amount. And yet again, we can see the entire triangle in this instance. Now, here's an example of what I was mentioning earlier, where you don't want to just hold on forever the moment something breaks out. In this case, there was a very clean breakout, and it began moving back toward its breakout, and in fact broke beneath it. And if I were along this position, I would have been stopped out here, because once you have a breakout, anytime you descend beneath that breakout level is not a good sign. Now, you may well have been stopped out and seen the stock pop higher and wonder if you did the right thing. Well, as you can see, over the long term, you definitely did the right thing, because in spite of quite a clean breakout here, the stock really only moved higher for a couple of days, and over the course of months really fell hard. Now, the descending triangle is basically the same pattern turned on its head. You've got a horizontal line here representing support, and a descending trend line representing a series of lower highs. And in these instances, you will see that the breakdown beneath the descending right triangle often precedes a drop in price. Sometimes it takes a while to really get moving, and other times it's quite sudden and quite dramatic. Here's an extraordinary example in this case, where we have our support line, a hard breakdown, and very interestingly, a very strong pushback to the breakdown level. And this represents the really the best of all worlds, because if you were to short around this price level, not only has the stock very much tipped its hand in terms of potential weakness, but your risk is quite low, because the amount it would have to continue higher to stop you out of that position would be quite modest. In other words, if the stock was going to get back into the 50s and beyond, it would reveal that strength in short order, and it wouldn't take much of a loss for you to get out of that position. In this instance, that was not a problem, because it fell a little lower than its prior low and then really collapsed after that point. Here yet again, the supporting line isn't absolutely flat, but close enough for our purposes. And that completes our look at the ascending and descending triangle patterns.